Welcome back, everybody. Magnolia on Money. This is Ed Cox with your weekly market report coming from Magnolia Wealth Studio here in-house. Kind of a wild ride today. If anybody was watching the S&P 500, you saw at one point during the day we were down over 2%, clawed the way back, and actually ended the day positive, a little over 1% on the day. So wild ride. Volatility is here to stay for this year, I'm afraid. And so what's driving volatility? So we see last week, the S&P had its worst week since the pandemic. S&P was down 5.7% roughly. We saw that the growth stocks have sold off with the new year, but the Fed is becoming more hawkish than anticipated. And so, we're looking at rising bond yields, and uncertain economic impact of the Omicron virus has crept in, and then along with what we've seen recently unfold in Ukraine with the U.S.-Russian relations. So a lot of uncertainty coming into the economy through a couple of different avenues there. But let's talk a little bit about inflation, which will kind of pour into what the Fed is doing. So last year, 7% annual change in consumer price index is the largest increase in nearly 40 years. So I'm going to go to my screen real quick so you can see a graph. So you can see here the yearly change in inflation, has been accelerating. You can see that there in where it's circled. But if you go all the way back, 82, 83 is where it was last time that it was this high. So inflation has proven to be more stubborn and widespread than the Fed expected. And so, policymakers are now expected to start the rate hike cycle as soon as March, and looking at reducing the Fed's $9 trillion balance sheet. But, this has put pressure on sectors considered long duration and have loftier valuations. So, like parts of the tech sector, as well as sectors that are considered bond-like. So real estate, utilities that have high yields are being affected by this. So as the market continues to adjust to the tightening of monetary policy, we're going to see more volatility creep into the markets. But at the same time, we don't really feel that the Fed is going to act quick in its tightening. From a standpoint of, we don't think they're going to raise rates really, really fast when they start. And so we think that the market can kind of stomach this. And historically, stocks can struggle initially after a Fed hike, their first rate hike. But returns 6 to 12 months after that first rate hike, 85% of the time have been positive. So that speaks really well of where we could end the year. And I still feel we're going to end the year in positive territory. So I hope this is helping you guys kind of understand where we are with the economy, what's going on with the Fed. We're going to continue, like I said, to march by their drum, and you'll hear a lot more about that in the coming weeks. But hope this is helping. Make sure you follow us on Facebook and our website. We'll continue to send out the emails. But y'all have a great week. God bless, and we'll see you soon.